I think one of my favorite quotes about valuation was Jay Coppell. So a recession is the investing equivalent of jumping out of the window, and valuations just tell you what floor you're on.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Okay, so I originally wanted to do the podcast, Jim, because we get to this time of year and everyone starts making their calls, right? Like, the big banks, and everyone is like, next year is going to be, and we've come off of 2 really good years of equity returns, which obviously the year before was like a complete bear market, and a huge drawdown.
It was ugly.
Really ugly year for equities. And on top of that, a really ugly year for bonds, which is so uncommon in the US market for those to go down, simultaneously.
Right.
At least the last, couple decades. And so now you start having people say, well, we've had this run up, and now you start getting this divergence where the bears are becoming bulls. And some bulls are still super bullish, and they just say like this bull market is still young. It has room to run. It's got legs. The average bull market is, if it makes it past the second year, it's usually a 5 or 7 year bull market, right? Like a lot of commentary from, the guys of the likes, like maybe like Ryan Dietrich on that, which he has some great commentary. And then you start having the people, that are scared, like, hey, this is like the valuation is so high in the market. Markets are so overvalued. This can't possibly, basically go any higher. We're in the 97th percentile of historical valuation. And so there starts to be this conflicting. And then to top it all off, you have the investment banks come out this last week with their projections for next year. And in almost what I would consider like the most insulting way possible, they all come out always with their projections. And it's always like, we guess, A, and the other person just guesses like A plus 1 or A minus 1.
I know, they're like plus or
it's
minus
like
3% over last year.
Which if you go, if like I've talked to people that work at the big banks and the economists and stuff there, and they all say it's like because you have to hedge off being wrong. So like if you think the year is really going to go, up 30%, you just have to be the guy that has the highest forecast, right? So if everyone else is predicting 12, you just have to make sure you predict 13, because then when it comes in at 30, you can say, well, we were the most bullish, but that way, like your tracking error isn't that big over the peer group, if you will, right?
It's the over-under game.
Yeah,
you just have to be a little bit more right than everyone else.
Yeah, exactly. And so what they've all come out with this year is basically the market next year is going to be, they think the S&P 500 will be up something around like, between 8 and 9%, which is like a historical average.
That's
which is like,
because they're just looking at long-term numbers as far as I'm concerned.
Well, it's like the part that's like intellectually frustrating to me is that if you go look at all the studies, is like the only thing average about the market is that it never has the average return.
Yeah, right.
It's like the average year doesn't have the average return. It's so uncommon for it to actually.
It's not a normal distribution curve, is what you're saying.
Well, it's like. It's like the S&P averages out, over the last 30 years to, whatever, an average, compound annual growth rate of, 9-10% a year. But it's because it's like, 25, 25, 25 minus 20, up 15, down 8. It's just not, it's not like 10, 10, 9, 11. It's not linear at all. Right. It averages out to 10, but like the idea of it doing 10% a year is really uncommon. From like a range perspective. Right. And so you can't, at least I feel like you can't rely on those forecasts at all from the big banks. They're burdened down by the rules of big Wall Street. And, they have all this fundamental analysis. It's the over under game, whatever. And so the more I thought about it, I'm like, I got to talk to Jim because like, you're one of the smartest people I know, Jim, right? CFP is like, that was like a weekend activity for you to get a CFP. I mean, you have a CFA, a CMT, a master's degree in foresight, right? Like statistically predicting the future. And so you have all the tools at your disposal to kind of come up with these forecasts. But I think one of the things I like the most is that you really look at like the cycles, and it's not an emotional thing about, Trump took office and tariffs are going to have this macro,
Right.
Everyone's got a macro call. I don't think you really care to look at the macro picture the same way compared to letting your more quantitative analysis, right, kind of guide the picture.
Yeah. Well, I tried looking at the economics behind things, and we're all told, the economy matters, but I never had a lot of success just looking at the economy as it relates to the markets. And that's partially because the stock market is a leading economic indicator. You're going to see changes in stock prices before you see changes in the economy. So you can use the stock market to predict the economy, but you can't use the economy to predict the stock market.
Yeah. Typically leads by what, about 6 to 9 months on average?
6 to month. Yeah. And in fact, the Federal Reserve does use the stock market performance in its index of leading economic indicators.
Yeah.
So there you have it.
Yeah. So I do want to talk about what your kind of forecast or outlook is for next year, where you think we are kind of landing in some different cycles that you follow. And that's what I really want to focus in on today. And then all of a sudden in the last hour of trading today, it's like so today's Thursday, the 18th, or sorry, correction, Wednesday, the 18th
December.
December. On Monday, we had the Hindenburg Hindenburg Omen confirmation indicator. I don't know if you follow that at all.
That's
heard of
that's
that.
an oldie, but yes.
Yeah. So it triggered for the second time within a 30-day period. And like there was a lot of fundamentals. Like I've really been looking at charts lately, just going like, I don't know if there's anything I really want to put new money to work in right now. There just seems to be
from a bottom-up perspective, you're just running the screens and you're trying to see what makes sense to buy here, and you're not coming up with much. Right?
Yeah, it's like, our small caps working, our mid caps working, is value working, is growth working, is tech working, is gold working, is commodities working, is oil working, is our bonds working. It was like, every single thing I was looking at basically had some kind of negative divergence, like where I'm just like, the chart doesn't look really compelling to say, let's put it to work. Let's go ahead.
Divergence is key. And briefly speaking, what divergence does is in my world, sort of divergence indicates trading volume, or trading volume influences divergence. And if stocks are going up higher and higher, and you don't have higher trading activity to back it up, then you've got false new highs. Right.
Yeah.
And I think that's probably what you're looking at here.
Yeah. And it was a number of, I mean, I was looking this last week, just trying to sort through all this stuff. I mean, I was looking at money flow indexes, on balance volume, RSI, MACD, candle patterns, relative performance. It's just, it was, I mean, none of it was really there. It's like, where do you sort of hide out to get some, yield? Well, you kind of almost wait for some kind of confirmation. Meanwhile, ironically, the one thing that was like, there was some divergence, but you're kind of scratching your head going like, I think it's going to actually blow through this, was Bitcoin, and then that kind of retraced today too. Not a ton. It still held over 100,000 though.
It's still a risk on, risk off asset.
Oh yeah.
Longer term, I think it could be a really interesting hedge against the dollar, for example.
Well, yeah, that's interesting. The dollar is one of the few things that went up today, though.
Yeah.
Right. In a sea of red, the dollar, that flight to safety, if you will. So it's just been an interesting thing. I think some of the stuff there's been a potential setup in gold. I think we've seen now a breakout on the pattern in that. I think to the downside. So I don't think gold's going to be the flight to safety asset if this volatility continues. I mean, the candle, the charts on like equities are I mean, that's kind of a horrific candle when you have a candle go from,
Right.
like in the last hour of trading, it just
I think they
falls.
call it what, dark cloud cover, something like that, is one of those
I don't even,
candlestick patterns.
I think it is called like just run for the hills candle.
Yeah,
I don't know what the
right.
technical name.
Mhm.
I'm sure there's a technical name for it and I should know it, but what I just look at it and go, a candle that is, the size of the entire range of the last,
I think they call that an engulfing bear, right? When the bear just ate everything.
Engulf the last month and a half of trading. You know what I mean?
Yeah.
So
Well, markets climb slowly and drop quickly, as you know, right?
Elevator, escalator up and the elevator down. But here's like something that's interesting is, so I'm just looking at like the S&P 500, and so you have this, well, let me do this first. So totally opens the day above all the moving averages, and in the last hour, it not only breaks down below the 20 period exponential moving average, but the 50 period moving average.
Do you want to do a screen share on that at all? Like, is that
sure?
Something that you can do here?
Mm-hmm. So you have, check this out. So it's like you just,
there it is. Yeah.
Look at that. And it busts right down through the 50-day.
It blows us all the way down to.
But look at where.
November.
But look at where it caught the support at the close of market.
Perfect resistance support line right there.
Right. Yeah. Right at that gap up on the morning after election.
And that's just straight up technical analysis, right? I mean, if you know charts, you know where to find those levels.
So what's interesting is like, I mean, if you have enough foresight going into the last like 3 minutes of the market and you're trading your own personal account, you might be able to look at this and say, let's go ahead and, hop back in the market on this. We did have one strategy today that, we had one signal today that fired and it was going back in, but it was going back in today kind of regardless, actually. So that'd be
can you pull up an RSI on this one just for fun?
Yeah.
Index? And that's one of those oscillators, and oscillators are great for showing you these extreme oversold or overbought conditions that, tell you when some of these turning points might come up. And so this isn't oversold yet, but you may get a reading on that in a few days. But look at the last oversold reading we got in August. Right?
Yeah, right back here.
Perfect. That was perfect.
That was. We ended up catching. I know we caught a little bit of whipsaw, kind of on the looking at some mean reversion.
There was some of that.
Kind of on the way up off the bottom of that.
Yeah, that was kind of a scary time.
Yeah. But what's interesting is it didn't. I don't think this quite put in a new low below this.
There might be like a day lag or two on that one.
Yeah.
They might put it up the day after.
Yeah. Well, that'll be just interesting to sort of watch. It looks like it is. It looks like it is a new low on that. So I mean, that's a little unfavorable.
Yeah, kind of blew through the 50-day here.
Yeah. Oh yeah.
And then also you look at the slope of the. Looks like the 20-day has rolled over as well.
Yeah. Well, and that is an exponential moving average versus a simple T.
Yeah.
But
it's the same EMA I use actually. I use 20 and 30-day EMAs on the crossover for my setup.
Okay. Look at the NASDAQ on this. This is pretty. Let me put this up here.
So you're pulling up the Bollinger Bands here.
Yeah.
We went from kind of this extreme
right in the high
situation right down to the midline there in Bollinger Land, which says the uptrend isn't broken yet per se, but that is a real pure regression to the mean, right?
Yeah. Well, and what's interesting is that did absolutely break through the gap up on, post election morning.
Well, that's, right? Another thing, right? Gaps tend to get filled, and it got filled.
That's what happens. Am I wrong on that? No, I'm not. I was wrong on that. Look at how I forgot the outperformance of growth relative to value has been so big.
Yeah, but we did cover that December gap that I see on the chart.
Yep. Covered that December gap.
Yep.
So anyways, that's going to be like a really interesting next couple of days to watch, and see what develops and if it pulls back through for, the Santa Claus rally, or not. I mean, credit spreads are just tight as all get
Just
out.
tight. That means they could get worse, which means that the junk could go out the window at some point, and they have not.
Yeah, you would expect. I mean, the only time spreads have been tighter was back here in, 07.
That's very optimistic on credit. Like, keep it short and keep it high quality. That's what I'm doing.
I've actually gone a little bit different from you on that. I think I've kept credit short in duration, very short in duration, and I've actually hedged the spreads. So we put on a trade that if the credit spreads blow out, we anticipate making some profit on that. But we give up a little bit of yield. We give up a little bit of yield for the carry on that. But I look at this chart and just say, I would like to be on.
Those
like
spreads are due to widen.
I
agree.
It's like I'm gonna keep averaging down into that trade. I think for the most part.
Yeah, that's a more interesting bet, actually, is to bet on widening spreads. I think that's smart. How do you do that? Like,
because I don't want issues with the overseers. I'll tell you offline. Really easy though. Cool. Yep. Not tough. Very, very easy way to put on that trade.
I understand. Cool.
Look at this, growth versus value. The outperformance and growth the last, couple of weeks has been huge.
It has been huge, but again, you're trading near the top end of a lot of trading ranges, which is why, Brandon, I've been selling more stocks than I've been buying for the last 3 weeks.
Yep.
For the same reasons. We're trading at the top end of the trading range, seeing some absolutely ridiculous valuations. And that makes me nervous. Things are a little bit too good to be real. And it was getting hard to find companies that fit my screens. I was just screening out everything. Just I couldn't find stuff. So I've been kind of on the sidelines for a few things too.
I know if I look at, I don't want to give away like I don't want to pull up so many tickers and watch lists that
your proprietary stuff.
Well, I'm not worried about telling it. I'm worried about people, misconstruing it and putting on a trade incorrectly and, yelling at me about it. But I think the last one is, that might be interesting to look at is gold.
Let's look at gold.
Let me pull that up. But I got it. Okay, so here's gold, and it just this ascending triangle is kind of the pattern that I had picked up, and so we bought a couple times in here, but this is, to me, this is some really, this may be a confirmation of a breakdown and kind of failure in pattern, right?
It's very clean.
You're below the 20 and the 50-day moving average. And then the other thing too is that, as it rallied back up, it really wasn't making new highs in the RSI. There's kind of no momentum behind that. So I don't really like that.
It's a type of divergence.
Tracking, I think tracking performance relative is not applicable to this conversation, but RSI again, failure to make new highs again after it put in that new low. It was just looking like, again, it's just a messy chart. It's like, you're not getting any confirmation yet. It made it up over the midway point, right? Made it up over 50 on this kind of rally right here.
It's also very gappy.
Yeah, it's all over the place. That could be a little bit because we're looking at a specific ticker rather than gold.
There it is.
But same sort of pattern, right? The pattern is still there.
Cool.
Downside breakout. Does it recover? I don't know.
I don't know.
Interesting time in the market, I suppose. Something will emerge though, right? Like something has to emerge as the leader.
Yeah. And as the saying goes, a trend is your friend until it bends or it ends. And that's why I'm a big cycles guy, because I think cycles tell you when trends bend and when they end. And if we have a few minutes, I'd be happy to share with you
Oh,
some charts I just ran this morning,
yeah. I'd love to see
um,
them.
which really are going to inform my forecasts for the next few months and going into 2025, because it is that time of year when you need to come up with your market forecast newsletter, right? And tell people kind of what you think is coming up. And this is a spectral analysis that looks at all of the major waves and patterns of the market going back to 2000. Okay. So just kind of walking you through this. The light blue line is the S&P 500 index. Okay.
Okay.
So we got that. And again, this goes back 2.5 decades here. And then on top of that, you have this purple line that goes up and down, kind of like an oscilloscope, right?
Mm-hmm.
And this is, in my mind, the most important cycle for people to look at. Um, it is a cycle that is 180 weeks long. It's sometimes called the kitchen cycle, named after an economist in 1920. So he observed this major economic cycle 100 years ago, and it's still ticking. It is still arguably the most important cycle for the market today, right?
Mm-hmm. Mm-hmm.
And on the right, we have some measurements of cycle strength, which I'm going to rank by cycle strength here, with the strongest on top, again, being this 180 week cycle that's in purple. And you're going to see that while you can't use this cycle to create targets for price levels, can't do it, it's not going to work, you can use it to help identify turning points in advance. And what I found so very interesting is this thing starts to roll over in the end of February, which is not super far away. And it tends to correlate to market changes overall. And you can see it really nailed the COVID bottom pretty good, at least the COVID recovery. It nailed the top pretty closely back in
Mm-hmm.
2021 before the Fed started messing with interest rates. It's
Yeah.
pretty good at the bottom here, in 2023, saying, hey, you need to really load up. This last run up was epic for the S&P. But it's saying, hey, maybe we're going to run out of gas in the not too distant future.
Yeah.
And, of course, past performance, not necessarily indicative of future results. Your mileage may vary. Consult your physician. All the disclosures need to be applied here. But out of all the cycles that matter long term, I think this is the one to look at, right? And it's not the presidential election cycle, which comes up much lower. There's another cycle that I look at that is also very strong, with a very high, what they call Bartell's indicator, or fit. So we're looking for strength and we're looking for fit. That 180-week cycle is a very strong cycle. This 23-week cycle is a very good fitting cycle, but it's not as strong. And if we look at that on a standalone basis, the 3-week cycle kind of weakens up for the next few weeks, but picks up in January, gets
Mm-hmm.
better, offsets that 180-week cycle, and it gives us a little bit of breathing room for the next 2 months. That's why they just kind of flatten out
Mm-hmm.
until, at this point, like April the 21st, right? So when I look at asset allocation on a strategic level, I think we may have a quarter to talk to people about their comfort with risk and where they want to go with regards to having cash and bonds and fixed income, and maybe lowering beta exposure in your portfolios. But this is the quarter to have that conversation with people.
Yeah.
So, yeah, and that is fresh. That 180-week cycle has shifted um, into turning a little bit sooner rather than a little bit later since I last ran this in the summer.
Okay.
So, yeah, coming soon, right?
That's that's interesting.
Hmm.
What other one of the things about cycle analysis that I understand is that you have kind of a primary wave or a primary cycle, if you will.
Hmm. Hmm.
And that's what you've maybe described, right? It's typically your longest cycle is your
Hmm.
primary cycle.
Yeah,
And
yeah,
then you
the
have
big moves.
you have the sub waves, right? So you have
Hmm.
something like a presidential cycle or a business inventory cycle
Yeah,
or some of these other
yeah.
cycles, and where they where you get some of this intermarket volatility on the way up when you're saying, well, hold on, the 180-week cycle is, it's going up. We're supposed to be in this uptrend and the markets are supposed to be great. We just had this 10% pullback in stocks. And
Hmm.
what you kind of cycle analysis would indicate
Yeah,
from an academic standpoint, correct me if I'm wrong here, you're the expert, is that's typically because there's the sub cycle is bottoming, right?
right.
Within the context of
Hmm.
kind of the
Hmm.
primary. So it
Hmm.
stays in the uptrend, but there's that moment of sort of weakness. Uh, However, when the cycles now that are offset line up, you have a pretty big magnitude of move potentially. So
Yeah, right.
where do when you start thinking about some of these other, shorter cycles, what's your thought on kind of our, the positioning and time, for that?
Yeah, well, I mean, one thing that you mentioned is sort of when do the cycles converge?
Mm-hmm.
When do they sort of all line up?
Yeah.
And I think the answer to that for me is still April, at least based on the cycles that I look at. Usually cycles, guys, suggest that you just focus on 2 or 3 cycles,
Okay.
because you end up with spaghetti if you add too many,
Yeah.
and you really want to focus on the good stuff. There is a much shorter cycle that I also follow called an 11-day trading cycle, um,
Hmm.
which interestingly enough, a lot of the guys that we hang out with, at NAAIM,
Yeah.
tend to use like 5 to 10 day holding periods on their swing trades because they found that holding period tends to give them the best trade-off between compounding and minimizing friction in transactions fees,
Hmm.
right? So that's my shortest cycle is 11 days, which we usually get a few of those each month. And I incorporate that into my model too.
Uh, okay.
Yeah.
Do you look at anything from a fundamental standpoint, like as confirmation or divergence from the cycle analysis?
Yeah. Yeah. So I think there's something called like the Schiller PE or no, the capital adjusted price to earnings,
Yeah.
cyclically adjusted price to earnings
The
multiple,
CAPE
right?
ratio.
The CAPE ratio, right? Which has been bearish for like 5 years. Like
Yeah.
they missed
What?
down on like everything.
Yeah.
Um, and that's sort of like the classic bearish indicator that people have been rolling out for a long time. And there's a real big lag on that. And I don't think you can rely on fundamental analysis only, but you're doing the right thing by saying that if there's just nothing that appears to be reasonably priced, then don't buy it.
Sure.
Yeah.
I think one of my favorite quotes about valuation was Jay Coppell,
Yeah.
like a couple years ago in Chicago, and he said uh, valuation. He said so a recession is the investing equivalent of jumping out of the window,
Hmm.
and valuations just tell you what floor you're on.
Yeah, right. Yeah, how hard it's going to hit, right?
He said, but it's not like you can be high valuations, but if there's no recession, if there's no cause, there's nothing fundamental to make it go down.
Doesn't matter.
Yeah, like the market doesn't go down just because it had gotten so high.
Hmm.
There has to be some kind of other driver. I think technical guys like us, we tend to say I don't really care what the fundamental reason is. I want to know I don't care
Direction
why the
is.
market's doing what it's doing. I care what
Yeah.
the market's doing, you know?
Yeah, but maybe, those valuations tell you how bad the injury is going to be and whether you're going to be
Yeah.
able to walk away from it or not, right?
Yeah. Yeah. Cause if it's really overextended, and the earnings don't come through, right? Like, so I think like one of the things that people forget is you have to, there's trailing PE or trailing price to earnings valuation.
Mhm.
And then there's forward looking price to earnings. And the forward looking price to earnings on the market, it's overextended, but it's not egregious.
No, not at
Um,
all.
the problem comes if the earnings estimates don't meet expectation, right? So if the economy doesn't
Yeah, right.
grow in the way that it's anticipated and priced in that it will, then all of a sudden you go from, okay, well, if earnings, if earnings at least come in on target and multiples don't expand, then the market should be pretty flat. To all of a sudden, hey, there could be a pretty big drawdown back to reality in terms of valuation.
Sure.
And that could be,
And, and,
15,
and interest
20% pretty
rates,
easily.
interest rates kind of come in the way as well because it really messes with your the way that you discount future earnings, right?
Hmm.
It increases the cost, the time value of money, as it
Hmm.
were. So I think this is kind of why everyone kind of freaked out today a little bit was, oh my gosh, we're not going to get, a lot more in the way of
The
rate
interest rate
cuts
cuts.
next year,
Yeah.
which, we shouldn't. We should have expected that to begin with because we've been having a pretty healthy economy for the last 6 to 12 months.
I,
You know,
I've really been looking at the bond market the last,
you gotta,
year and a
you
half.
gotta.
I think like,
Yeah.
I always say this when I was in college, it was like the bond, like if you talked about bonds, it was like, you're a real snoozer, dude. It's like,
I
how
know.
boring is the bond market? It's like
It's the
everyone,
canary in the coal mine, though.
but it's the
Tell you.
biggest, it's like the biggest market out there. And it's a very diverse market. I mean, right. Like as diverse as stocks could be,
Yeah, yeah.
bonds are even more diverse, right? It's like pick your
Mhm.
duration risk, pick your credit quality. Do you want bonds from small companies? You want bonds from big companies? There's a lot, and then you start repackaging it, right? Like you want an individual bond from Apple, or do you want you know, Ginnie Mae, Freddie Mac, MBS? You know what I mean?
Yeah,
That's
they
like
get weird,
they
right?
can get really
Mhm.
weird. Um,
Yeah.
but I was looking at it going, I think the mortgage actually, like mortgage rates have kind of been telling us between the 10-year and the mortgage rates,
Yeah, yeah.
the stability and the spread there,
Hmm.
the inability for mortgage rates to drop down below 6 and their inability to kind of break above 8, I think has really produced a trading range.
Hmm.
And I've almost started there and worked it backwards to where do I think the neutral rate sort of could land at the Fed, and what would be like, what is the market? What do I feel like the market's sort of pricing in from that angle? And
Hmm.
if you look at what your term premium, your historical term premium over the overnight rate for the 10-year is what, one to one and a half. You know,
Yeah, yeah, yeah.
uh, and so if you have a Fed funds rate at 3.5, you're 1 to 1.5. Well, that puts you right in the 10-year where the 10-year trading range has been. And
Yes,
and
yeah.
then and then you look at the historical credit spread on the mortgages over the 10-year, and boom, you're locked right in those ranges. So to me, it kind of tells the bond market's sort of pricing like, I don't think this can really go much lower than 3.5 in
Mm.
terms of the Fed rate. I mean, eventually at some point, I'm sure they'll just puke and put it back to
Yeah,
zero at some
yeah,
point in
yeah,
the future. But I think in the foreseeable future,
yeah.
I mean, I
But
think
yeah, you're right though. You got to look at what the bond market is doing in terms of credit spreads, in terms of defaults as well,
mhm,
because when you have higher interest rates
yeah,
and when you have defaults, you have tightening money supply, right? You have
mhm,
less liquidity in the market, and liquidity is everything for stocks. I think that's
yeah,
probably the most important variable,
yeah,
uh, more so than really anything. So there's something else in terms of cycles that I didn't get to yet. I don't think we even had this conversation yet about the 18.6 year real estate cycle, sometimes known as a Metonic cycle, sometimes known as a Gann cycle.
yeah.
And this is a big long-term cycle on real estate prices. which in turn gets tied up to stock prices. And if you look at that cycle, it is scheduled to hit rock bottom right around 2028. So you combine that with what I'm saying on the kitchen cycle, that 180-week cycle, that says that 2026 isn't going to be a lot of fun. 2027 could be kind of rough. That seems to to converge, or it seems to match up with this 18.6 year real estate cycle, suggesting 2026, 2027, it's going to be kind of a mess, right? And you need to think ahead and figure out, how do you want to position in advance of that, if that should happen.
And so that's just, so on the 18.6 year real estate cycle, that is indicating, or like, how do I want to phrase like what I'm trying to ask here? So we're already in the downside of the cycle.
That's what it would say. But we're not in the panic side of the cycle.
Okay. Right? Mm-hmm. Yeah, that's interesting, because I think there's a lot of fundamental drivers behind real estate. I'm pretty heavily involved in the real estate community. I'm certainly not a real estate purist. And I look at the world very objectively, especially as a technicals guy. Like I really don't care why, I care what. But that being said, I have a hard time thinking that the price of homes are like going to quote unquote crash. But one of the interesting things I think about is the inflationary, environment. We've had these continued prints up in CPI and PPI, right? Inflation is kind of pointing back up. Commodities have kind of looked like they've bottomed right now. Those look like they're kind of bottoming on a pattern. And so, commodities typically go up during periods of inflation, in general as an asset class. And so if those are kind of picking back up, that would be, inflationary. You have inflation data picking up. You have, and so all of a sudden, I don't know that the price of homes are going to crash, but in the terms of inflation adjusted dollars, right? It's like if inflation ticks up and wages go up, but the price of homes don't go up, then really the price of homes went down,
right? Relative
to
in terms of purchasing
power, right? Like for the Bitcoin guys out there, it's like homes went down in value relative to your Bitcoin. You know what I mean? It's like, so
Bitcoin,
or gold. You know what I mean? I think 10 years ago we would have probably used the gold example, right? Your home price in gold is worth less than it was, or whatever. But it's no one thinks about it like that. So they're probably thinking, well, my house is going to be pretty stable in price. But realistically, if your house stops going up while everyone's making more money and inflation is ripping, then your home is sort of going down in value.
But here's the thing, right? Is that real estate for particularly new investors or new buyers is a highly, highly leveraged asset, right? When people are putting down like 10 to 20% on their first home, and if houses go down 5 or 10% in price, they've lost half their money, right?
Well,
they've lost half their equity.
That's why I've always said that real estate, that people say real estate makes the most millionaires, which is, by the way, that's just something Dale Carnegie just made up. There's no evidence to back that.
Yeah. Right.
But people will say that. I hear that a lot by people. Real estate makes more millionaires in this country than any other investment. Well, like, yeah, but if you're putting 10% down, that's like trading futures contracts as a retail person. It's like, you'll hit it big. But if you blow up, you really blow up. You lose it all.
You really will.
And no one talks
underwater.
Well, no one talks about the other side of the trade. They never say, but it's also bankrupted the most amount of people in the country, right? It's like you're look at like outcome bias, I think is the right like behavioral finance term.
Right. Yeah. Right? Plus the fact that if everyone loses their shirt in real estate, then nobody wants to talk about it.
Yeah. Well, that's the whole point, right? No one. Yeah. If I said, trading, commodities futures with insane leverage and Forex created the most billionaires in the country by owning hedge funds or something. It's like people would be like, yeah, but who the heck's going to, like, every person that goes out and tries to trade options that I know, you know, they lost all their money. It's like, well, yeah,
Right.
no, we're not talking about that side of the ledger. We're just talking about how, you know, if it works out well, you know, it really works out
Yeah,
well.
yeah,
It's
yeah.
like,
Yeah, it
yeah,
cuts
it's
both
confirmation
ways.
bias. Look,
Right.
I'm not here to like, and I'm not saying people shouldn't buy real
Hmm.
estate or shouldn't use leverage. Um,
Mhm.
but I've always said that about real estate, that the power that, you know, what's interesting about real estate as an asset class is the, you know, everyday investors access to a high degree of leverage.
That's where it is.
It,
It's in real estate.
it's
Mhm.
yeah. Cause if you go as just a, you know, Joey off the street, open up a, you know, Robinhood account, like they're not going to let you trade futures on Robinhood as just, you
Yeah,
know,
just out
somebody
of the
that,
gate.
yeah, hey, you know, I have a, you
Right.
know, nice little white collar job, work at the
Oh,
hospital, whatever, and I'd like to trade futures contracts. It's there's some questions I could ask there, and it's not
that
exactly the
creates
easiest thing to figure
liquidity.
out.
Leverage creates liquidity,
Yeah,
and
yeah,
that creates inflation to a certain degree.
yeah. Well,
Hmm.
uh, but when things come unwound, you know, it's the least favorite accounting method, right? Last in, first out. Uh,
Yeah.
you
Right.
know, because the people that don't have gains to sit on, right? And I would encourage everyone to think about Bitcoin, you know, the hodlers, you know. So if you go out right now and somebody buys Bitcoin at 100,000 and it goes to 95, they're panicking. Right? They're like, man, I'm already down 5%. How much lower is this going to go? If it goes to 90, they're really, you know, now they're really getting
Hmm. Hmm.
itchy to
Hmm.
sell. Well, the guy that bought at 10,000 is like, oh, I went from 100 to 90. What do I care? Right?
Yeah,
He's
but the
sitting.
latecomers feel it
The
more.
latecomers feel it the most, and that's where they
Mhm.
make. And so what happens is they behaviorally, this is what happens. They run for the door the fastest, you know,
Mhm.
and or they get squeezed to the door and they're forced to sell the fastest because they didn't have enough gain to meet the margin expectations.
If they, but
You know,
you should not be buying Bitcoin on
no,
margin.
no, no.
Like
I
that kind of comes with its
yeah,
own
yeah, yeah.
margin.
No,
You know what I'm saying?
I didn't mean like trade on
Yeah.
margin. I just meant like from a personal financial management perspective, right? Like if you bought Bitcoin at 100,000, you're looking at it and it goes to 90, you're looking at like, man, that's a 10% drawdown. That's, you know, like I just had 100,000. Now I have 90. And behaviorally, it's harder to stomach that, you know, to sort of meet
Mhm.
the quote unquote, you know, this fictitious, obviously like margin. So if all of a sudden, you know, another bill comes up due, you're thinking to yourself, I'm getting out of this before I lose any more money because I got a bill that's
Yeah.
due or, you know, an expense that could come up. And that's you're probably investing with some really bad planning or lack of financial planning.
Right.
But the person that, you know, put $10,000 in Bitcoin at $10,000 and has just not touched it and it's not 100,000, they're not even thinking about selling at 90,000. They're probably not even thinking about selling at 50,000, right? They're just,
Right.
you know,
They're
you go
just
to 50,000, they still 5X their money.
Mhm.
And so the longer somebody has a holding period, the less leverage they sort of have. And that's true in real estate where, you know, paying off the mortgage over time should naturally de-risk your investment, right? Because your equity should go up, in appreciation of the property and your debt goes down as you know, pay down principal. It's
Mhm.
kind of like a target date fund almost. I kind of think of it that way
Yeah.
sometimes.
Yeah. Or yeah.
Natural target date fund. Um, and so, you know, the people that buy an apartment complex with no leverage are in a totally different financial situation than the person that bought, you know, a second home with 5% down, you
Mhm.
know, and all of a sudden is going to have a hard time, you know, paying property taxes
Yeah.
and insurance and utilities or whatever. And now they have to sell it. You know, it's a different situation, right? They're figuring
Yeah.
out how to, you know, get out before the place is totally on fire. Whereas somebody that has real estate with no leverage or really low leverage, they're like, oh, we'll ride this out, no problem. You
Yeah.
know, property
Yeah.
values recede. I got plenty of cash flow. You know,
Mhm.
I'm good. We can, you know, we'll weather the storm. It's a different trade.
Well,
Same asset
and you're
class,
going to
different
have
trade.
generational gaps there too, right? You know,
Yeah.
sort of the boomers and people that are paid off are not going to be as worried about it or as sensitive
Hmm.
to the millennials that just got their first house, and they have all the risk exposure, and they're going to be more price sensitive as well.
Yeah. So that cycle is due to bottom in 2028, which would from a cycles perspective would indicate you would expect towards the end of 28 or 29, the price of housing probably starts appreciating again.
Yeah, but at the very end, yeah, going back into like what, 2028 to 2029,
Yeah.
we could turn the corner. It might be safe to, start loading up on real estate and equities again at that point. They don't ring a bell at the top and they don't ring a bell at the bottom. You're looking for excessive pessimism
Yeah.
in all things to really load up and buy stuff cheap.
I totally am talking out of my gut at this point, but having a pulse on the real estate industry, I could see that being very supportive of the cycle. I've been really surprised by the optimism of real estate agents and mortgage lenders the last couple of years that, rates are just, the Fed's going to lower rates and, interest rates will be back down and, mortgage rates will be back down in the 4s and everything's going to be honky dory and it'll keep going up. And I'm going to just stick in, even though the transaction volume's been low, my pay is low. I've learned the last couple of years that, the Fed just lowers rates and everything goes back to normal, that, V-shaped recovery and boom. So I just got to stick through it a little longer. Yeah. And that excessive pessimism it's taking a longer amount of time. And I could see that drawing out to 2028. I mean, cause that's, what is that really? Another 3 years, kind of 2 years. And then that final third year.
But we have seen West Coast prices peak. If you look at San Francisco, you look at Portland, they have peaked at this point. I think we can say that. But other markets have not. But you're still fundamentally seeing very expensive homes relative to personal income, for example.
Yeah.
Yeah.
Well, that's the other interesting thing about real estate too, is that it is probably one of the easiest places to find an inefficiency in the market. So you can still have housing in a bear market and find a great trade or a great property to buy and come out great, right? If you have inside information, right? If you know, you can buy up some farmland and Walmart is trying to buy the land across the street and build their new headquarters. You know what I mean? It doesn't really matter
if they make their money.
Well, that's how Congress makes their money.
Farmland right before they set up the mega highway.
Yeah.
Right.
But that stuff can't happen in real estate, right? Or you find the guy that, sells his house and just wants to get out of it, or the estate sale that the siblings just are going to fire sale it because they want to get the money out of the estate or whatever. There's still opportunity in real estate.
And a lot
when guys like you and I look at it.
As well.
Yeah, I think guys like you and I, we talk about the housing market, but we're talking about the average across the entire market, which is, the housing market in Bentonville, Arkansas is going to be a lot different than the housing market in Portland, Oregon. It's two totally different markets. So we talking big averages.
Yeah, that's right. Big picture, right?
Yeah.
Big stuff, so.
Well, I think because it relates to us, big picture, relates back to the big economy, and the big economy is what, sort of drives the stock market.
Top down.
Yeah. To a degree,
bottom
right?
up.
Yep.
Right. Top down's all the, strategic allocation, and bottom up is all about picking individual investments. And sometimes the data that you can get from picking individual investments can tell you what's going on in the big picture.
Yeah. Yeah. I tend to be more of a, top down, looking at the big picture and then, drilling down to, what's driving it, in the macro, or in the micro, but, right. Like if you look at, what sectors are leading, drill down to, okay, well, what names are in the sector, or what industry groups are within the sector, what's working, what names within that are working. That can tell the story. 'Cause all of a sudden you can say, well, consumer discretionary or, is going up, and it's like, oh, no, actually they're all going down except for Tesla. Tesla's going up. It's like, it's just a big enough weighting. So, you can drill down and say, well, that might be some decent divergence. That's a lot of negative breadth. So.
Yeah. They call that the market internals sometimes. Just not just the big picture, but what's going on inside.
Yeah.
That big picture.
Yeah. Anyways, well, gosh,
Yeah.
I always
Time flies, right?
time does
Very fun
fly,
conversation,
and I
by
get
the
to
way.
this point, and I'm thinking like, who else in the world is interested in this conversation between you and besides me
Yeah,
and
I
you?
know.
It's like,
We have a good time, right? I
it's
don't know if,
to,
anyone else is going to understand this conversation, but I thought it was great. Thank you.
to most people, I think this has probably got to be one of the most. But I will say, last time he came on the podcast, I actually had
Mhm.
someone, one of my friends, reach out and I think I saw him, and he's like, "Dude, I listened to that podcast with the Jim Lee guy, and my mind was blown." And I was like, "What? Like what? What he say?" And what he's like, it just makes so much sense that you're going to have a stronger correlation of up days in the S&P 500 following these inflows from just paychecks hitting on the 1st and the 15th
Right.
or whatever,
Right.
and he's like, there's stuff out there that just makes sense. So he thought that was interesting.
Cool. Cool.
So I don't know.
Yeah. Well, it's really fun hanging out with you and talking about this stuff because it's just so darn interesting, right?
Yeah.
And just kind of see the world through some of these metrics and figure out what happens next.
Yeah. Yeah. Well, I appreciate you taking the time. If anyone wants to get in touch with Jim, you can get in touch with him directly at your firm is StratFi.
StratFi, yeah. Mhm.
StratFi.com, is that your website, or?
Yep, STRATFI.com.
Yeah, it's short for strategic Foresight Investing. Yeah.
Mhm.
And certainly we people can reach out to me, and I can get them in contact with you as well. Or you just reach out to me and pick my brain on stuff, whatever. But Jim is one of the smarter guys I know. So
Cool. Thank you so much.
appreciate you taking the time, and I look forward to seeing you at least no later than May, I would think.
Yeah. We're gonna West Coast, I think. Is the May conference, April conference?
Yeah, next NAAIM conference is in May, out in where it's out. I keep not Santa Monica. It's somewhere out there towards like LA.
It's in California.
Yeah,
Mhm.
this is over on the West Coast. But I'll be there.
Cool.
And I we'll have to pull up the cycles and see how far this
Going on. Yeah.
Yeah, well, it'll be interesting to kind of round up at that point. So, okay. Well, I appreciate it, Jim, and we'll be seeing you around.
Excellent. Thank you so much.
Take care.